So the central bank, the what called the NTB, Nigeria Treasury Bills auction on Wednesday, that auction was undersubscribed by close to 20 billion naira. That's quite very surprising. So where are the yields and what is the state of the fixed income market? Let's chase the yield around a little bit, chasing the yield curve. If you're in the market, you know how to chase the yield. It's like surfing on the seesaw shore. You know, it goes all the ways, then it goes all the way down. Then if you know how to ride the waves, then you just have a nice time. If you don't, then you get whacked down into the waters. Eronmosele Aziba, an investment analyst from Afrinvestors here this morning to help us chase the yield curve.
Good morning, Bosun.
It's a nice chase, isn't it?
Yes, it's quite a chase.
When the yield is sweet and the market looks good. So, but last week, let's start from there. How did the central bank end up with about less than 20 billion, about 18.4 billion naira in shortfall in subscription to its treasury bills?
Well, yes. Over the
is it an appetite thing or is it a yield thing?
Over the past month, we've actually started to see yields trend higher. So considering developments across other global markets, we started to see investors price this into valuations in the market. So based on the rate that we could see in terms of the range of bids, we noticed that investors have started bidding at higher rates, and this could have been one of the reasons that we saw for that in the market.
On a subscription.
Yeah.
I'm just going to go straight to this. What should I watch more these days? It looks like a lot of stories are coming more from the outside, shows than from within. The stories about emerging markets still going into further flip-flops. There are stories this morning from Reuters that some sovereign funds are going to exit equity market. That is what Olufemi Awuyemi says as another layer to a challenging market outlook. Then you find the rate issue. Then you have the ECB in Brussels trying to balance out its quantitative easing. So, all put in the basket, looks like both local and global macros and markets seem to portend what for our own yield curve?
Well, definitely. With these external factors that we've seen, it definitely plays a role in how our markets are shaped. Although the impact is more visible in the equity space, developments in these external factors. But when you come down to our local fixed income market, we know that about 50% of the market is dominated by the PFAs and the domestic players who usually aren't that active in terms of their trading activities, especially for the PFAs. So we might not necessarily see a significant reaction to any possible external risks. But on the other end of the curve, now we're faced with some sort of dilemma in terms of the CBN. We know as closer to the end of last year, there was already guidance that from this by the first half of the year or entering into the second half, we could possibly see a rate reduction and adoption of an easy monetary policy. But given the current situation where we have developed markets, rates trending high, I've seen the US Fed 2 rate hikes this year, also guidance from the ECB on seizing their quantitative easing plan. So looking at the fact that we're starting to see a hawkish stance from these global policymakers, it would be somewhat counterproductive for us to now decide to start reducing our own rates at this time, because we definitely need to keep our instruments attractive to attract the funds to come into the market.
We're caught in a crossfire here, in the manner of speaking. Our own debt restructuring program of the Buhari's administration, which was announced around September last year, seemed to be going on track during the Q4, then into the Q1. Then before we could grab that, things move with the Fed, with the ECB, and everyone else in between, and the emerging markets started getting punched. So why was that the reason why foreign investors or investors are asking for higher yield on our own assets?
Definitely. I mean, with a market like the US, where you have reduced risks in terms of their returns, a lot of foreign investors will be more comfortable with the returns that they would get from a developed market when rates are increased there, as opposed to investing here across frontier markets where there are higher risks. We have political risks as well that could also come into play. You have security. Considering all these risks, it became a safer option to invest in this developed market. But we started to notice a trend, especially across frontier markets, sub-Saharan Africa, Eurobonds. Following the second rate hike by the US Fed, we saw generally bearish performance across frontier markets. We saw a lot of sell-offs across these markets. But over the past 2 weeks and even last week as well, we started to see some increased buying activity, which shows that investors still know there's still that value in the market that investors can still take advantage of. They're still trading at attractive yields for investors to key into. But considering these risks that I mentioned, and also considering the fact that we're seeing rate hikes from developed systemically important central banks, we expect investors to price this into our market, and that's what we are seeing shape out now.
You folks rolled out late last week, a very interesting report, and I'm still digesting the executive summary, almost 20 pages, and I don't know how you folks had all the time and resources to write an executive summary about 20 pages. But on page 7, this is about the fixed income market, and you folks talk about paucity of supply of instruments in the fixed income market. So let's switch this to the corporate side of the conversation. Do you think we would likely to see more corporate bonds in Naira corporate bonds in our market for the rest of the year? I'm looking for strategies and what will be the multivitamins for anyone appetite to come to the market and say, I'm a corporate. I think this is a good time to swim while the tide is high.
Yes, so if you go back to our first report that we launched at the start of the year in January, based on market conditions at the time, and considering the fact that we had seen the change in debt structure strategy from the government tilting towards foreign borrowings as opposed to domestic borrowings, we believe this would create an opportunity for corporates to then approach the market, because the crowding out effect that had hitherto existed had somewhat reduced. So we could see some corporates come into the market to issue instruments. But with the recent increase that we started to see in yields in the market, we do not believe it will be that attractive for corporates to approach the market. On the contrary, what we've seen in the first half of the year has been an increased issuance of commercial papers. So as opposed to taking credit lines from banks, which are about over 20% thereabout, we've seen a lot of corporates approach the market, issue commercial papers.
Is commercial papers the new in thing? Well, Dangote is just in there with a 150 billion program.
In the first half of the year, we saw
sidestepping debt, sidestepping equity, or bank cash. So you just go for commercial papers to sort out whatever your financial shortfall is.
Yes. So for that short-term capital raise, we've seen a lot of these corporates approach the market for commercial paper issuances, and currently you have probably an average rate of about 15.3% thereabout, which is just about a 2 to 3% spread between treasury bills. And this is more
how much lower than a normal,
much lower than what you get from much lower than what you get from a bank. And for us, we believe this is going to be sustained in the second half of the year.
Who's speaking of commercial paper?
Well, there are investors that are the institutional investors buying into these instruments as well in the market.
In your report, you talked about also a double-faced strategy to trade or chase the yield curve for the second half of the year. Or what is the phase 1 and phase 2?
Well, so on the one hand, you have a case for CBN to ease in line with with their guidance.
What if central bank does not ease?
Well, so we don't actually expect them to ease. So for us, we believe there should be a play at both the shorter end of the curve and at the longer end of the curve, so that you don't miss out on any of the potential opportunities. So what we started...
Make it simple. Let's make it simple. If I have 100,000 and I'm coming into the market, into the fixed income, and I'm looking at the yield curve, still double digit, I was getting over my head towards the end of last year, looking at a single digit treasury bills for, it doesn't look like that is going to happen anytime soon again. I think things have since moved back up. So if I have 100,000 and I'm putting that on the table and I want to split it into your what you call a two-phase strategy. Yeah. How do I play with 100,000?
So we believe you could...
Naira, not dollars. Just in case anyone is watching, I think I have $100,000.
No, so. But we're sure you probably have $100,000 somewhere. But you know, you can split it.
The tax man is watching.
We advise a split between short end and longer end, like I mentioned.
Of the yield curve.
Yeah. So put in a certain proportion in short-term instrument. You could do a 50-50 split, for instance, because we're also seeing yields trend higher at the longer end of the curve. So in terms of
if I buy long-dated instruments, which are treasury bills of 2034, 2037.
Yeah, and then the shorter term instrument. I mean, with 100,000 playing in the bonds market is going to be next to impossible. I mean, with 100,000 now. So yeah, for those shorter tenured instruments.
We thought there's a market here for those of us who are the bottom of the pyramid.
You can play in the savings bond space, but in terms
what's my rate?
But maybe about 11-12% thereabout. But you might as well just put the money in a 365-day treasury bill, for instance.
Yeah.
But I mean, for more retail investors who have little funds, you know, with as low as 5,000, you can play in the savings bond space. So maybe that's another opportunity they can take advantage of.
Yeah, well, that looks like I was thinking about commercial papers. Then I noticed that commercial papers, the lot sizes.
Yeah, huge
way out
sizes.
of this world.
Huge sizes.
15%. That looks much better than the savings Naira bond, monthly Naira bond.
Yeah, I mean it's higher than that. But going back to your case of having 100,000, regardless of how much you have, if you approach us, AfriInvest, we'll be able to find that investment opportunity for you to take advantage of.
You folks are going to make money, so you're going to find a way. You know, I thought you were going to return my 100,000, and I'm just going to the guy next door. But again, that's not commercial, really. But again, the market's going to look really interesting moving forward. It's going to be a little bit quiet as we get to everybody talking about politics. I think some folks are going to get a little bit jittery. I don't want to use the word scared, but at least a little bit concerned about where we're going and pile a bit of their money. Even when government is a continuum, and it's going to like to be a change of government, or you have a continuum of the current administration, folks want to put some money away somewhere, somehow, not under the pillow.
Well, I mean, for any investor who is who has a more shorter-term investment horizon, we believe they'll probably still play at the shorter end of the fixed income markets, because if you even look at the outlook on the equities at the moment, gains are expected to be somewhat lower than what we've had in recent months. So we believe that's where investors will stay. But for those with a longer view on the market, then you can take advantage of longer tenured instruments.
Do you think the fixed income needs some multivitamin?
Well, I mean, the CBN has...
Well, equities need some vitamins, but do you think fixed income?
Well, if it's in terms of liquidity, I mean, we've seen the CBN continue with its mop-ups in the market, trying to reduce system liquidity. But at the same time, we've also had maturities come into the market. So we've sort of had this offsetting each other in the market.
Okay. We'll have a bigger conversation around managing market liquidity at this point in time, sometime in the future. Thank you very much.
Thank you.
And good morning. Thanks for coming through, having a great day. Eronmosele Aziba, one of the investment analysts at AfriInvest.